institutional investors from around the world are telling me over and over again that it's pencils down, that they are unable to make some big bets or some big investments at the moment as they're trying to figure out what is going on with the United States, what's going on with geopolitics generally, what's going on with the economy. At the same time, there seems to be a kind of confused aspect to their pause, where a survey that we did at AFIRE back in March, it looked like although 63% of those surveyed had a very negative outlook about real estate markets and the economy in the United States, only 8% planned to decrease their allocations to U.S. investing, and 44% saw a potential to increase. So there's this kind of conflict, I think, inside people's minds. One, on the one hand, certainly the commercial real estate industry in the United States looks attractive. And there's a lot of reasons for that. It makes sense for an institutional investor. On the other hand, current events and the trade war and everything else is giving people quite a lot of heartburn, at the very least, as they're trying to figure out what happens next.
You are listening to the AFIRE podcast, real estate, technology, cross-border investing, and the opportunities of a changing world. Let's start a conversation now.
So I thought it would make sense in the midst of this kind of confusing pause, this place where no one's pencils are up, and in Canada, their elbows are out. I think that's the slang for it. What do we do? How do we think about this and how do we go forward? So I invited AFIRE's good friend, Mark Zandi, a chief economist at Moody's, to explain it all to us, to give us a sense of where are we? What do we know? What do we not know? So thank you, Mark, for joining me on the AFIRE podcast.
Yeah, Gunnar, it's great to be with you. I was just looking back in time. I think it's been about a year since I was last on. I don't remember what I said. I'm assuming you don't either, but I'm sure I got it all right. That's what you asked me about.
Given that the whole world has changed, I don't think anyone can be held to what they said a year ago.
I appreciate that. That's great. Yeah.
But, it's interesting because what has remained consistent, whether it was the conversation we had last year or the meetings that we've had in the interim with AFIRE, is generally a relatively positive outlook for the economy generally and for real estate. Even the office sector, people are starting to get attracted to possibly doing some new investing in office, which was considered completely verboten a year ago. So there's a lot of positive going on, and yet. So, and I hear a lot of that from you when I listen to your wonderful podcast and read the things that you put out there, that there's still, it's not dead yet. I think maybe part of it. I feel like I'm in the middle of a Monty Python sketch, but, it's like it's getting hit, but it's not dead yet. Is that still the case? Are we still moving?
Yeah, we are. I mean, we came into the year in a very good place. The economy was growing strongly, creating a lot of jobs. Don't hold me to it, Gunnar, but I think we created 2 million jobs last year. That's a lot of jobs. Unemployment, 4%-ish, rock solid. Stock market at a record high, housing values at record highs. So, we had a lot going for us. It was the exceptional economy. I mean, I remember traveling in Europe I was at the European Commission, and they had just released this report by Mario Draghi, former ECB head and prime minister of Italy. And the question to Draghi was, how can we make Europe grow more quickly? And Draghi basically said, we need to be more like the United States. Let's do what they're doing. So it all felt pretty good. So yeah, it would take a lot to derail this economy. I think the tariffs and trade war are doing a lot of damage, but I do think it's not dead yet. I love that the way you put it. I think if we could find a way to take an off ramp here and de-escalate the trade war quickly, particularly with China. I mean, that's obviously the biggest trading relationship and a lot of uncertainty there. But if that can happen in the next few days, few weeks, I hesitate to say few months. I think we can make our way through without a recession. If we can't find that off ramp, you can't get some kind of arrangement with the Chinese to get those tariffs down, at least from where they are right now. They're prohibitively high and they're crushing trade, and that's just. I think even Treasury Secretary Besson said that it's just unsustainable.
Yeah.
Assuming they can figure out some kind of arrangement, I think get on that off ramp. I think we can still make our way through without a recession, but we need to do it fast.
One of the questions that one of my members brought up is that what has happened, at least at the moment, in terms of China, with a basic stop to the trade activity or a significant slowdown. could very well just be a preview of what would automatically happen over the next 5 to 10 years anyway, because of the demographic shifts in the United States. That our power as a consumer nation may have an expiration date on it just based on the demographics of the people that are in this country in terms of when they're buying. As the baby boom generation is entering its fixed income years, or really kind of moving through them, they're already kind of in there. But how does that change the equation in terms of China's ability to continue to benefit from a rapacious demand in the United States? Is this just a preview of coming attractions in terms of the road we're going down from a demographic standpoint?
To maintain that metaphor, I think we're well into that movie. These two economies are decoupling pretty rapidly. They were already, before all this,
Right.
Going back to the first trade war in 2018-19, I think the decoupling started in earnest at that point. We do this pretty interesting, cool analysis looking at trade flows between industries across countries over time. And you can kind of do like a starburst of all these linkages and how closely integrated economies are. And if you look at the US China, go back to 2018, we were highly integrated and kind of in the center of the global starburst. These two economies were driving the train.
Right.
If you look at the data from 2023, that's the latest data that we have, they're completely separated. So we've completely decoupled to a very significant degree. And so I think, this trade war we're engaged in now is just accelerating a process that was already underway to a very significant degree, and now is, firmly in place. And I just think, going forward, I think our trading relationships are going to be very, very different. We're going to be trading China's going to be focused in other directions than the U.S., and the U.S. is going to be focused in other directions than China. We're just moving apart.
I was talking with a friend and said, well, I'm going to be interviewing the chief economist today from Moody's. What would you ask? And she turned to me and said, when is it going to get back to normal?
No.
And I think that's an interesting kind of question to ask, because it's getting harder and harder to believe that there is a back in our future, that it seems like enough has kind of, fundamentally shifted that whatever we return to is not really a return. It's kind of a new environment. What do you think?
Yeah, I think there's a lot to that. I mean, just the globalization, for 20, 30 years, we were in a process of integrating with the rest of the world. The whole world was integrating. The globalization process really began in the 80s and took flight in the 90s. And then, of course, in the 2000s, after China entered into the WTO, we were off and running. Now, of course, that also had a lot of downside. The net of that was a positive,
Right?
A slam dunk positive for the world, including the United States. But it did leave a lot of folks behind. That the concern about manufacturing is a real one.
Yeah.
That did get hollowed out here in the U.S. during that period, and many communities got nailed as a result, and thus the politics that we have now and how fractured we are politically. So I think there is a lot to that. But that, we're not going back to globalization now. That's done, at least for the foreseeable future.
Yeah.
So that's that was a major secular ongoing trend, very powerful with lots of positive implications. And that's over. So there's no going back there.
Mm-hmm.
Now, having said that, I do think the U.S. can get its groove back. I mean, I do think if we can get on the other side of this trade war,
Yeah.
There's a few other kind of things we got to work out, like the tax and spending legislation. We've got the Treasury debt limit. There's immigration policy. But if you look forward a couple, 3-4 years, and we'll get to the other side of that, I think we could find our footing again. Again, the American economy is a pretty amazing thing, very resilient, and I think we'll find our way through. But you make a great point. I don't think there is any getting back to that past normal. I hesitate to say new normal. That just seems hackneyed, but
yeah.
In this case, maybe that's the right way of describing it, the new normal.
I think there's been, at least over the last 30 years, a very clear path for product. It's like our own Silk Road from China through Long Beach and to the rest of the country. And in real estate, you develop next to the road. Everything from the cities that have done better and worse, how are they connected to that road of goods, that overwhelming road of goods through Long Beach in California? And how does that impact everything kind of downstream from that across. I wonder, especially, if certainly the efforts are successful, you have more manufacturing taking place in the United States, you have more manufacturing closer, which is, again, these are trends that have been in play for a while. We've been talking about it. Some things have happened. Maybe this will accelerate it. If that is the case, and if no matter what the case is that it's less shipping of goods from China, do you see kind of a reconfiguration potentially across our supply road, virtual in some ways, but that it comes through Long Beach? Should we be thinking about that perhaps in a different way?
Yeah, I mean, I do think the centers with industrial space, warehouse, and transportation distribution, certainly here in the the foreseeable future, will be under pressure. I'm just don't know, because the volume of trade is just going to be lower going forward. This goes back to going from globalization to deglobalization. It just means less trade.
Right.
So there are going to be fewer imports, there are going to be fewer exports. So the volumes are lower. So anything that depends on those volumes will have to adjust, and that goes to the industrial space markets. There's no doubt about that.
Mm-hmm.
And you make a good point. You might see more manufacturing activity in different parts of the country over time, and so that causes a reconfiguration of where you need that space.
Mm-hmm.
It also means higher prices for the stuff we buy that we import. So goods, things that go on store shelves. And so that's a tax, and we're going to buy less of those things. So if you're in the retail space market, this might depending on what you sell, obviously. Certainly if you're selling toys or furniture, or clothing, there may be an issue. You're just going to be selling less of it, all else being equal, and therefore you'll need less space. So yeah, I think there's all kinds of implications for the demand for different types of commercial real estate and where that CRE is going to be located going forward that we're just going to have to work through. And by the way, Gunnar, it's not just, there's a lot of other things going on too.
Yep.
That have big implications for where CRE is going to be needed and what type of CRE. What's coming with regard to artificial intelligence. That could be quite significant in terms of what it means for jobs and what kind of jobs and where those jobs are going to be, and therefore the demand for office space.
Mm-hmm.
And I should have mentioned the other thing on globalization that I'm sure many in the leisure and hospitality industry are feeling firsthand is it's affecting, obviously foreign travel. You can see that very clearly in the data. And I suspect that that's going to, it'll come back, but I don't know if it comes all the way back. Certainly not for a while. And so that affects, demand for hotels and other leisure hospitality, amenities, that kind of thing. So I think the implications of what's going on the trade front and also what's going on with AI, tremendous implications for the commercial real estate market in lots of different ways.
An investor that was a member of AFIRE once pointed out to me a kind of an interesting correlation. And that was when you're talking about international investors, so we're not talking necessarily about trade, we're talking about capital coming into the US, that the countries tend to invest. So think sovereign wealth groups and pension plans. So the institutional capital from other countries tends to correlate with where their expats went to college. So he used this as an explanation for Malaysia, who, they invest a significant amount of institutional capital, but not in the United States, in London. And that's where all those young men and women who are now deciding where to place the money went to school. Right now, in the United States, we've been the beneficiary to a great extent as a receiver of international capital from the fact that we have so many expat students that come to the United States to go to school here. And that the environment right now is not entirely hospitable to an expat student, someone coming from other countries to go to Harvard, Yale, Stanford, wherever they go. And I am concerned about kind of the after effect of that. And I'm very hopeful that we'll come to some sort of, we will mellow out a little bit on this in terms of, the concerns around immigration. So that we can continue to see those nice, young, bright students that will be running their countries and running their countries' endowments, so that they, continue to see our U.S. cities as a good place to invest.
Yeah, it's interesting you say that. I had not heard that, but it makes total sense. And I was looking at your survey data, and I saw of the favorite cities, Boston is kind of right up there, top
Yeah.
five. But then Boston's a great city, but why Boston? Now it makes a lot more sense.
Boston, well, New York is usually at the top,
Usually,
almost
yeah,
always. And again, it makes sense not just if you went to school near New York, but it's New York. So,
it's New York.
it's like it's London, it's New
Yeah,
York, it's Hong Kong. These are cities that everyone knows and that everyone pays attention to. But again, just from the standpoint of understanding a particular market and having a network in that market, where do you start your best, strongest network?
yeah,
It tends to be when you're in college. And that can go with you until your 40s, 50s, and beyond in
totally.
terms of those relationships you might have outside of the country. So,
Yeah, and I think your broader point is also very critical. I mean, I go back to that Draghi report on how can Europe grow faster, and one of the observations is that the U.S. does attract the best and the brightest from around the world.
yeah,
I think one of the key ingredients of our secret sauce that we attract those folks, and that there's as you point out, some reason to be nervous about that in the context of all the kind of things that are going on. I mean, I know that Chinese officials are warning parents and kids about coming to school in the United States, and I'm sure that same kind of sentiment is being felt in other parts of the world, and that makes me nervous.
yeah, yeah,
We need those folks because they're going to drive the train going forward. I mean, just take a look at there's a lot of evidence, research that shows that immigrants tend to start companies at a higher rate than native born, and it kind of is intuitive. If you're an immigrant, you by definition are a risk taker. It's not easy to
right.
pick up your family and come to another country, maybe not know the language or certainly the culture, and so and of course, new business formation is critical to innovation, productivity growth, and growth overall. In fact, just another data point, technology really gets diffused throughout the economy only when or quickly when new businesses form and optimize around that new technology.
Right, right.
It's very difficult for legacy companies to adopt like new technologies and and bring it on and make it work for them. But new companies, they're built around it, and
Yeah.
of course, it goes back to immigrants. So, yeah, I hear you. I think that's really critical that we're able to remain a hospitable place for for young people around the world to come here and learn and stay and invest here.
I've often been confused, to be honest, about when we have discussions around immigration, back and forth. It's, these people, they're either positioned as a problem, as a threat to people's jobs, a threat to safety and security. Or the other side of the argument is, but we need to care about people because, that's the compassionate thing to do. And there's part of me that wonders if it would make sense for us to shift that conversation to what are the economic benefits of allowing for a more streamlined, a more rational kind of immigration process so that we have more of those risk takers, so that we have more of those small businesses, so that we have more of those potential investors in the future of our economy. And I agree with you. That's been the secret sauce for a couple hundred years, 250 years or so, has been that kind of steady connection to people around the world. And actually, from a standpoint of real estate, I think it's even stronger,
Yeah.
the case to be made for why you want foreigners to own your buildings. And there's a very basic reason, even beyond economics, which is if a foreigner owns my building, he's less likely to bomb it.
That boy, that makes perfect sense. You're absolutely right. Yeah,
It's about peace.
they got skin in the game. So
Skin in the game. And I think to a certain extent, that's part of what the equation was, whether
yeah,
you like how it turned out or not. And there are pluses and minuses and all with the trade relationship with China, was that we all had skin in each other's game.
right.
We benefited if we both succeed. We have problems if we both fail. So I think that can be a pacifying or a moderating influence, a way that economics and politics can interact in a positive way, that there's a positive reinforcement loop if we all have skin in each other's game, if you will.
Yeah, totally. Yeah, I mean, this may sound a little odd to the ear in the context of all the things that are going on now, but I'm actually optimistic that at some point down the road, not this year, next year, but maybe towards the second half of the decade, end of the second half of the decade, we'll find our way to meaningful immigration reform. I mean, it's hard to remember. It feels like ages ago, but just last summer, Congress, uh, Republicans and Democrats came together and were very close to passing what was a pretty reasonable immigration reform bill
Right.
that allowed for more immigrants of the skills that we need, both at low skill that work in construction and work in agriculture and leisure hospitality, but also high skilled tech workers. It just got obviously undermined in the election process, and given all the politics around the southern border. But I think if we can, it feels like the southern border has been nailed down, and if we look forward 2, 3, 4 years, we may get a political window open, and if we get that legislation through, that goes back to getting back to something that's more normal,
Right.
and that we preserve that ingredient that's key to our secret sauce. So I don't think it's taken us a lot longer than it should have to get there,
Yeah.
but I still hold out real possibility that we will get there.
From your lips to God's ear, I think is the phrase. I hope so. I do think that we rely on immigration more than we realize.
Yeah.
Our economy, certainly in real estate, the demographics, you can't, it's like fighting against the tides. It's just not going to happen. Immigration has driven much of our economy and driven much of the real estate economy for a long time. You want it to be done in a way that makes sense. You want it to do in a way that that's orderly in some form or fashion. But to get there, you can't be just trading bumper sticker slogans. It seems to me,
Totally.
you need to be able to look at it in a little bit more of an adult manner and just kind of, all right, well, how do we make this work, and how do we make this work in a way that makes sense?
Right.
There's been certainly last year, there was a shrinkage of international investing in the United States, unrelated to these geopolitical issues, much more around just being able to find deals that made sense, and currency and everything else that was kind of driving the level of non-US investing in the US. And again, a lot of them are saying they want to increase it. Can you see a scenario where that kind of opens up a little bit, maybe even on the near to medium term?
Well, I think we got to get beyond the trade war,
Right.
and that could take a bit of time. I don't think years, but certainly months. So maybe I don't think 2025 will be the year where we see that investment pick up to a significant degree. But you look beyond that, and we get to 26 and 27, 28. Yeah, I think there's a real possibility. A lot does depend also on interest rates. Where interest rates are, and I worry about that as a risk. I mean, long-term yields have right now they're kind of sort of where you'd expect them to be,
Yeah.
but there's a lot of reason to be a bit nervous about our deficits and debt, about the safe haven status of the U.S., about Fed independence. There's some issues in the plumbing in the bond market. The broker dealers that make that market, for various reasons, haven't allowed their balance sheets to expand to be consistent with the amount of debt outstanding.
Right.
I mentioned the Treasury debt limit, coming up. So,
Yeah.
a lot of those issues we got to kind of work through those things, get to the other side. But so I don't think 2025 is the year. I'd be surprised if the folks that answered that they want to invest more actually pull the trigger or sign on the dotted line, might be a better way to say it.
Right.
But maybe by 26, 27, we'll start to see that investment kick back into gear, because I do think the economy is resilient, and we should be able to navigate through, and we could be in a very different place a year or two down the road.
Well, I mean, so far the jobs figures have held up quite well. We
Yeah.
got a recent report, I guess it was last week, but that didn't include the kind of post big tariff announcements. But I mean, what are you watching going forward to see, kind of where things are going, or what are the things that are making you think one direction or the other in terms of where things are going?
I do watch sentiment, that's really important, consumer sentiment. So I watch the Conference Board survey of consumer confidence carefully. That is down quite a bit in
Yeah.
bordering on signaling recession, very close to that. Taking it literally, based on history, I would say we should be able to sneak by. Thus, my optimism we can avoid recession.
Yeah.
But I'm watching that because if consumers pack it in, lose faith, and stop, just grow more cautious in their spending. Very hard not to go into recession because the American consumer drives the train. And then, of course, jobs. And of course, these things are very closely related. But, so far, you're right. The job market's hung tough. There's some weakening. If you look under the hood, hiring is down. Number of open positions is down. Hours worked are down. So the next thing to happen will be layoffs. And if that happens, we're going in. But that, we got a data point. This is Thursday, May 8th. Unemployment insurance claims remained relatively low. That's a window into layoffs, and right now they look okay. So as long as that remains the case, I'm watching that closely, but as long as that remains the case, we should be able to navigate through. So far, the data says, high, yellow flares everywhere, but no red flares yet.
No, it just isn't showing up there. And there's stuff that's counter to this narrative that's happening all over the place. One of the things I found interesting at the end of last year, beginning of this year, NYEDC was reporting that they expect a significant shortage in Class A office space in New York City.
Oh, is that right?
That it hasn't completely recovered. Certainly B and C is struggling in valuations and in just occupancy. But to see that there is a recovery in certain areas in ways that people didn't anticipate. And putting all aside the ongoing back and forth on, you need to be in the office, I won't be in the office, back and forth between employers and employees.
Right.
The reality is that there is still kind of a movement upwards in terms of demand for office, which also implies, people are not anticipating massive layoffs if they're thinking that way. But again, we'll see. I mean, things can change dramatically in a few hours, as we are being reminded almost daily.
Yeah, I guess the other good thing is not a whole lot of supply either, right?
Right.
I mean, yeah. So you just get a little bit more absorption, soak up that space, that allow valuations to stabilize. And they have kind of sort of stabilized, right? I mean, the data I look at suggests that transaction volume is low, perhaps so maybe it overstates the case. Maybe there's some latent weakness there, but generally, it feels like, we're finding some stability there with regard to price. And I think that goes back to the fundamentals. The absorption is there and the supply isn't. So, vacancy should stabilize and come in, and that should be helpful.
Well, it's certainly we stopped new construction, which, probably is a helpful thing. Although, there's a plus and a minus to that. I mean, right now, our biggest issue in the United States is we're about 4 million units short in terms of housing.
Oh.
And that number is only increasing. And everything from, local regulatory issues to NIMBYism to, bizarre regulatory and rapidly increasing construction prices, both because of materials and because of labor. We're just not building new units, not at the pace that we need to. If anything, it's slowing down. And that can choke economic growth in markets because you can't get the employees. You can't get what you need to keep growing these businesses.
Yeah, no doubt. Actually, we're doing this study. You might be interested in. I'll send it to you when we're going to publish in the next few weeks, where we're looking at or estimating the housing supply shortage, both for renter and homeowner, for sale and for rent, by block group. So block groups are these teeny weeny geographies.
Yeah.
What we're finding, interestingly, is that the shortage is not. It's not a problem kind of at the high end, certainly not in the rental market. It's oversupplied.
Right.
It's not at the very low end, because you have some light tech. It's kind of what I'd call workforce housing.
Yeah.
And a lot of it, it's a lot of communities, but the most acute shortages are actually in kind of mid-sized cities. That's where, and the other interesting thing is, because it is at a block group and you can look at this spatially. You can go into any geography. Say, I'm from Philadelphia. I look at the Philadelphia city. That's the county of Philadelphia. Even in that county, you see wide disparities across the geography. Some areas are undersupplied. Some areas are oversupplied. And they can be right next to each other. So it's a very interesting development. But you're absolutely right. That shortage has been developing since the financial crisis back 15 years ago. And given the restraints on building and now given the higher costs, in part because of tariffs, in part because of immigration policy, it does seem to suggest it's going to take us a while under any circumstance to kind of work through that shortage, and that is a limitation on growth in many of these cities because people you need to work just can't find a place to live
Right.
close enough to their work.
I'm curious. I'm intrigued by how in the environment that we're in, where suddenly things that were, encouraged are now being actively discouraged. Think of things like ESG or DEI.
Mm.
How the response is interesting. It's as much an adaptation as it is a change in actual activity. A recent study that Accountability published a few days ago suggests that a majority of the companies, at least that they were interviewing, are not changing anything around sustainability,
Mm.
but almost all of them are changing their language, which I find kind of interesting, if not Orwellian,
Yeah.
in terms of how we are adapting to a different rhetorical landscape. And it's not always in terms of action, it's quite often in terms of just how it's characterized.
Right.
Are you seeing anything along those lines as you're looking across?
Oh my gosh. Yes, indeed. Everywhere I'm seeing it.
Yeah.
You mentioned ESG, climate, another really good one. Just the way people are talking about it. So yeah, I do worry that the rhetoric actually turns into reality at some point. That to your perspective, that so far it's mostly rhetoric and people are still executing on the things that they were before. They're just framing it differently, talking about it differently.
Mm-hmm.
But I don't know if that's going to be the case a year or two from now. I wonder.
I do too.
I worry.
Well, what gives me some hope from a sustainability standpoint is that it's, at least in the real estate sector, it's pretty clear
Yeah.
that you make better risk-adjusted returns if you pay attention to this stuff.
Just economics.
It's pure evil capitalism writ large. It's not save the world. It's this is how we're going to get better returns for our investors.
Oh, I know. I can't get insurance, or I'm paying a lot more for insurance. So,
Yeah.
So I got to mitigate that risk.
Absolutely. You have to pay attention to it. There's economic reasons to look at it, not necessarily, save the world reasons. Although that should be a reason, but it isn't because we're evil capitalists.
The economics are front and center for sure.
Well, I saw something interesting, and
why did you ask that question? That's so interesting.
Because I'm hearing from my surveying a lot of like cross things where something appears to be one thing and it's another.
Yeah.
And especially when it comes to things around sustainability, resilience, issues around, worries about increased storm damage, increased expenses in terms of insurance, drought, fires, et cetera, that one of the things that we've been asking investors for years now is, do they see at some point, and one of the real estate stories of the last 3 decades has been the growth of the Sun Belt. It's been like a no-brainer investment.
Right.
If you're in the Sun Belt, you're going to do well, especially if you're providing housing. But the question that I've been asking is, do you see over the next 10 years, not now, but over the next 10 years, do you see any kind of mitigation of that growth, slowing of that growth, and perhaps an increase of growth back in, say, the Great Lakes and the North? And most of the time, when I've asked that question, I've received maybe 10 to 14% of the respondents have said, yeah, I see something like that happening in the next 10 years. And this time it was 30%.
Oh, really? Oh, interesting.
So, there's long-term institutional investors have long expressed concern about some of these areas, especially after storms. But at the same time, they've continued to invest. They're still investing. In fact, when I asked them what their favorite markets right now to invest in, Miami came up as number 3.
Yeah.
So
Dallas is number 1, isn't it?
Dallas is number 1. So they continue to look at these areas that might be seen as having higher costs now because of insurance, because of damage that is occurring, because of infrastructure elements, but they're still investing there. And yet there seems to be a heightened concern, perhaps, or maybe a sense that this freight train that's been going at high speed might be slowing down at some point in the next 10 years.
Yeah.
How would you react to that?
Yeah, I think it makes sense. I mean, you can actually see it in the housing market. I watch the house price data very carefully. And, if you go into Florida, for example, particularly in the southwest part of Florida, kind of Naples up to Tampa, prices are declining. Condo prices everywhere in Florida, East Coast, West Coast are down. And I think that, that direct result of the climate impact on insurance, the cost and availability of insurance.
Mm.
And I hear more anecdotally, I haven't seen it in the data, but more anecdotally about multifamily owners and developers in Florida, rushing off to London to try to find insurance and then figuring out it just is not affordable. They just self-insure, they're just self-insuring. So, I think that is becoming more of an issue. And the other thing in the southern part of the U.S. and parts of the West, you do have more of a question of oversupply, right? That's where you didn't see you haven't seen the building. And I'm focused on the housing market more specifically, but you just haven't seen the same kind of building in the Northeast and Midwest that you've seen in the South and in the West. And costs are, affordability is more of an issue, and costs are rising more quickly in the South and West. Again, going back to immigration, in the construction trades, I think over a third of workers are immigrants. That's nationwide. So if you go into the South and West, it's well over half. So you kind of get a sense of the impact on cost. So you kind of add all of that up, and it says, the South and West are still going to be, they're still going to be attractive in the sense that people are going to be, those migration flows are going to continue, but maybe not quite to the degree that it has been. It's not going to be the slam dunk that it was historically. It's going to be more difficult to make those returns, and you're going to have to be better at picking your spots and the locations where you actually invest.
It seems to me that the era of no-brainer investment strategies probably are behind us.
Yeah.
That we have less of that than perhaps going forward. That you're going to have to pick your targets even more carefully than you did in the past.
Yeah,
as we look forward. Well, this is helpful. If there's one thing that you think people are getting wrong right now, that they're not paying enough attention to, that we should pay more attention to, what do you think it is?
I do worry about Fed independence. I do worry about that. There's a lot of drum beating around it, particularly in the context of the current environment, because the Federal Reserve has put interest rate policy on hold, and they've been point blank about why. They're saying, look, I just don't know what's going to happen with policy, economic policy, and particularly trade policy. And, tariffs make my life as a central banker very difficult. I mean, what do I do? Do I respond to the higher inflation that results from the tariffs? Or do I respond to the weaker growth that results from the tariffs?
Right.
What do I do with that? And so the Fed Reserve really is stuck in between a rock and a hard place. It doesn't want to lower rates, and so pressure is intensifying and will intensify further as the economy clearly will weaken.
Right.
And so I just worry about that. I do think, there's very strong evidence, research that shows that in countries where central banks are less independent, you end up with higher rates of inflation,
right?
And meaningfully higher rates of inflation. And I think we want to guard and things. We have our own case study in Richard Nixon and Arthur Burns in the early 70s, and that contributed to the hyperinflation we got in the subsequent decade. It wasn't the only reason, but that was a key reason. So, I don't know that people are focused on that enough yet. Now, but probably it's a little bit premature. Everyone's so much to worry about and think about. So there's only so much you can worry, at the same time, but that may come to the fore here, sooner rather than later.
I mean, I think it's a favorite pastime of investors to bark at the whatever the Fed decisions are and reveal their hostility. But I think if like dogs, if we actually catch the mailman, that's not necessarily a optimal scenario here.
Exactly. Yeah, exactly.
It's fine to complain, but maybe you don't want to actually get your hands on the machinery at this point.
Right. Good point. I like the way you turn a phrase. You've got nice stories. I mean, this is great. No wonder people love your podcast. This is really good.
I hope they do. If I have a fraction of the audience you do, I will be a happy camper. I think that would be wonderful.
Well, you're kind to say, and I really appreciate the opportunity. Thank you.
Likewise, and I look forward to seeing you speak at our New York conference in September.
Cool!
If you're still on board with that.
Oh, of course, I love AFIRE.
Good.
Yeah, absolutely.
Good. Well, we'll see you there in New York in September, and have a good summer. And hopefully, things will be very calm.
I'm sure you're right. Is that a forecast?
Yeah, nothing much will happen between now and September.
Exactly. Yeah. Exactly.
We have, of course, been speaking with the chief economist at Moody's, Mr. Mark Zandi. Thank you so much for joining us in the AFIRE podcast.
Anytime. Thanks for having me on, Gunnar.
You have been listening to the AFIRE podcast. Remember to subscribe on your favorite podcast subscription service, such as Apple, Spotify, Google, Stitchers, and others. AFIRE is not engaged in providing tax, accounting, or legal advice. No content in this podcast is to be construed as a recommendation to buy or sell any asset. Some information included has been obtained from third-party sources considered to be reliable, though AFIRE is not responsible for guaranteeing the accuracy of third-party information. The opinions expressed are those of its respective contributors and sources, and do not necessarily reflect those of AFIRE.